Hello, Warriors. How's everyone doing? Alexander, fingers crossed for turnaround Tuesday. And what? Looks like there could be fades everywhere. Hi, Richard. K-Man, how are you? John, Hugo. Hi, Ryan, Paul.
Hello, Dale. Good.
Hey,
Good
K-Man, guys, Brock. All of you action junkies, how are you? Everyone doing okay?
I'm good.
So, all right. So, I have some questions. I guess this is the real feature this morning is the S&Ps. And when you look at them, I didn't extend this line, but we're right there at this trend line. So it's got to hold it. Otherwise,
that's what we're watching as well. Yeah.
Okay, so have to hold that.
And a couple of bounces we had from just below 4,600 into year end, and then the last one as well.
Yeah, here. This is a line. Okay, so a lot of people are going to say we're going to have a breakdown. So yesterday I was talking about Friday's lows holding in the yen, which so far it is, even with risk off. It's not terrible being up 6, right? And the Dixie, the premature declaration of the death of the dollar for the 1000th time in my career still may be premature. And silver's holding up better than gold today. It's only down a penny, and gold's down 5, and oil's at new highs. So this is the big picture. Yields, I think the 10-year is diverging up here. It made some new highs last night, and then I'm going to open it up to the team. So potential reversal day up here in 10-year. I don't know if that's
going to 185 during the Asian time. It is strange because I was up for the Bank of Japan. So Bank of Japan disappointed the Reuters sources trying to call for a change of tone. They did say, well, they did change something about a risk self-balance, but all the rest, Kuroda affirmed that they are not ready to change anything. They didn't even discuss anything on rates. That drove the yen weaker, and very strangely, right after the market was relatively quiet, and right after the Bank of Japan, all of a sudden the dollar caught a beat. The stocks started to come off. It seems like some players were waiting for the Bank of Japan decision to come out and then hit the market whatever happened. So
interesting.
Yeah, and then the rates spiked up to 185.6 or so in the 10-year. The 2 years are still above 1% though, and real interest rates are coming off. So somewhere that should, in theory, end up in dollar yen, but then we have to look at what the S&P is doing, whether it's going to hold this 46.10 or not.
Well, if you just take this move that we had from 3.5 to 15, and look at how this 200 held it on the 4-hour.
Yeah.
If we get through it and just add this move on top of 115, it gets you back to the highs. In fact, 1650, it gets you to the highs. So, I mean, these are important days. Is it's going to be a failing rally and we're, going to break down? And this was the major top, or is there one more hurrah left? That's kind of the way it looks to me.
It's on the short term, the 114, let's say what 2040, 2045 zone is a bit of a support, but I think it's especially the 113.5, which is the new 112.5.
Okay. All right. I know.
Yeah, and on top, there's this 200 on the 4 hours, and then if you look at it a little bit longer, there's a pretty important Fibonacci around 115.5. We might just be trading 13.5, 15.5 for a while.
Okay.
And that would coincide somewhere, I think, also with the S&P. If the S&P sticks in the rally, stays in the in the range. Sorry.
Yeah. Okay. Well, I think we'll know today about the S&Ps.
Guess so.
Maybe. Expect everything. The euro, which is outperforming the pound, is back under this blue line. And, you know, I showed it yesterday and it meant something because after we broke out, we pulled back right to it. And then we pulled back here. Now we're back underneath it. I don't think the euro, like I was saying yesterday, looks bullish. So, you know, that.
Oh, it's back on
So for
13.80.85 right as we speak.
Yeah, so you know, to me, this was just to shake out all the shorts and clean out buy stops. And
Yeah.
some people, you know, went with the breakout, like Ryan. Only Ryan was smart. That is, when there was no follow through, he started taking them off. This looks like new lows to me, and you know, that's going to be one more high in the dollar. So I don't know. A lot of the bearish rhetoric in tech stocks and the dollar was based upon, well, there's funds coming out of mega cap growth, and that's affecting the dollar because that was creating demand for dollars. You know, foreigners or crypto people were parking in mega cap growth, and so the dollar came off because big tech cap, big mega cap tech was coming off. Well, mega cap tech is going to come off today and the dollar's acting okay. Some Ellioticians would say this was still a triangle, like an ABC down here, and that we could still get a new high above 97. So I thought that was going to be supportive for stocks, but there goes that argument that the dollar is going to sell off because tech's under pressure. Because tech will be under pressure at the opening today, and the dollar isn't. Dollar's stronger than the yen today. Yeah. So how about Stell and Ryan? And
morning. Hello.
Hello, Stell. Morning. So the silver's acting a little better.
Metals in general are
boring.
Are what? Sorry.
Boring.
Yeah, they're not going along with equities, which is surprising. Obviously,
they're trying to bore us to death, the metals, right?
They're decoupled a little bit, but obviously, I think if we do continue lower in equities, I think they're going to have to follow. Even though, you know, if they don't, I'm going to be happy. But yields are higher, like you said. Interestingly, the yield curve is actually flattening. So
that's not good.
Yeah, that's not good. 2s10s, so 2-year, 10-year is below 1%, something like 80 basis points, I think, and 5s30s, 5-year, 30-year is around 55 or something like that. So that shows you that, yes, yields are going up, but clearly the market thinks that, you know, this is not something that's going to be a, you know, a proper multi-year cycle that's going to persist and, you know, rates are going to be high for a long time and everything. No, it looks like the markets think that this is going to be another policy mistake, or it's going to be reversed relatively quickly. So
that is going to be the mistake, actually.
What?
That it'll be reversed too quickly.
That one
they
once
won't
again,
let us go through the pain again, just like 2008.
Exactly, and as we've said, the more you prolong it, the bigger the pain, because you know it's inescapable to have to go through it at some point, right? And the more it gets prolonged, the worse it becomes.
Look how much bigger the you know, all the bubbles are now compared to the Great Recession.
That's one element. The other element is you see it, right? You see it, you feel it. Inflation, which of course isn't only 7%. By the way, remember we had this conversation in the past few weeks.
Past 4 years.
No, the past few weeks having to do with inflation. You know, measuring inflation with the pre-adjusted Boskin Committee methodology is at 15% today. 15.
Yeah, 15.
Yeah.
That makes sense.
Yeah. Now, tell me if you believe inflation is 7 or 15. You know, I'll put my money that it's closer to the pre-adjusted methodology that would say 15.
Yeah.
Anyway, yeah.
So I heard Kaufman said that the only way monetary policy is going to, everyone remember Kaufman? He was even before, wasn't he before or during the time of Volcker?
I
the
don't remember.
economist, Henry Kaufman.
Yeah.
He said that it was going to take what Volcker did to kill inflation.
Yeah, but the big question
At
is,
what cost?
yeah, how are you going to do that with the current finances? Because
the U.S. couldn't pay their debt with those rates, right?
The problem is that in comparison to when Volcker did it, the debt is a lot shorter term, and the debt maturities are, super short term, right? That's one point. And second of all, the debt and deficits are just unimaginably bigger, right? So if it was X times hard for Volcker to apply that in 1980,
right?
You can do the maths. Yeah.
Yeah.
Plus, don't forget that we live in an era that society and citizens have not even, have not even thought of a situation that they have to hear the words. You have to go through the pain. It's going to be a very painful adjustment period, etc. Everybody has been treating them for many, many, many years like, we should always give, society, a rosy picture that everything is going to be all right, that there's always an easy way to do things. And at some point, of course, that's not going to be the case anymore. I mean, you can't avoid the pain anymore. And then there's also going to be a lot of social unrest. And that's on a global level. It doesn't have to do with the US only, right? Because on a global scale, the same type of problems, we keep pushing them under the rug, right? But it is what it is. Now, having to do with tech stocks, it makes sense. Dale, you mentioned before tech stocks. It makes sense that the stocks that benefited the more from policies like extremely loose monetary policy, etc., are going to be the stocks that are going to be in heavy scrutiny when the environment changes, right? Because you can't have a monetary policy that's one way be extremely helpful for specific sectors, and then reversing that same policy isn't going to do the opposite, right? So it makes sense that there is some rotation. Now, why doesn't this hurt the dollar? Because I think that initially, as always, investors, instead of pulling their money out, what they initially do is they rotate. Now, once they see that things are really getting bad, that's when they actually pull out money, right? For the time being, I don't think we have a lot of money, escaping the stock market. For the time being, I think it's just rotating to, other type of assets.
Okay. Yeah. So the dollar might have one more hurrah with risk off here.
The dollar held the 94.5 key support area. And, I said that on the morning edge yesterday as well, that, as long as we're holding 94.50, it makes no sense to be bearish the dollar. So, we held 94.50 nicely. So, short term, it's impossible for me to be bearish the dollar above 94.50. Now we break through 94.50, and then, it's a totally different conversation.
And how about at new highs, Steve? If this is a wave forward triangle,
it is likely.
No, but I'm talking about it being a great short at new highs, because this could be a wave forward triangle, implying the next wave up would be 5 terminal.
Oh yeah, I agree. I think my longer term opinion hasn't changed.
That's what I'm waiting for. Yeah.
My longer term opinion hasn't changed. I believe the dollar is going to be under severe pressure at some point this year for all the obvious reasons. But looking at the chart at the moment, would I be shorting dollars here? No, not as long as we trade above 94.50, right? I don't want to fight the tape, right?
Yeah.
As they
Do you have
say.
any kind of downside targets in euro? Could we see like 111, 110.50 again? Well, we haven't seen that before. But
the euro has behaved perfectly so far. We had one little move higher, a consolidation, one more move higher. So I think that we have a confluence of supports at the psychological level of 110. I think we can even make it to 110. My first support area is actually at 111.50, and the next one is at 110.
Yeah, that's where this red line comes in, right around that same area. And then on the big picture, what we could have, Steve, is a big falling wedge from the highs in 2020. And you just draw some type of
Yeah,
downtrend line here.
although I have to tell you, I'm extremely skeptical about the shift that has taken place during the past few months. That, as I've explained, also when it was a very fresh development, I mentioned it explicitly. Weidmann leaving as the head of the Bundesbank, and of course from the ECB, in my opinion, was not for reasons of personal reasons as it was declared, but it was because he didn't want to follow anymore these policies, which immediately told me that there is there is an agreement in the ECB to keep on going very loosely. So to be fair with you, Dale, instead of putting my faith in which central bank is going to be doing the biggest policy mistakes, I'd rather own assets during this period that are going to benefit irrespective of which fiat currency is going to be depreciating the fastest.
Right. So I understand. Okay, so monetary debasement, and you can't trust any fiats. So that's when gold finally begins to shine.
And speaking about gold and silver, they're not behaving well here. So I believe they might see more pain. But there is one thing we have to take note of, right? And it is quite important. We went within a very short period of time from being full throttle loose monetary policy with no intentions to do something about it, to now be pricing in that quantitative easing is going to be tapered in extremely little time, that we're going to be seeing something like 4 hikes within 2022, none of which is going to be enough to tame the type of inflation we have at the moment, by the way. And that perhaps we're also going to go through quantitative tightening once again. What has gold and silver done during this repricing of monetary policy? Very few things.
Yeah, it's held.
Yeah, exactly. So imagine
people are bearish these markets
exactly
because they haven't done anything, not because there's been damage to the technicals.
Exactly. So imagine what's going to happen.
I can read your mind, man.
Exactly. So imagine what's going to happen when a policy reversal happens again, and then it's more than obvious that inflation was never the number one enemy of central banks nowadays, right?
Yeah.
So in my opinion, that's going to be the trade of 2022. I said it in the end of 2021 as well.
Okay, miners and precious metals.
And anything with intrinsic value.
There's some type of triangle that'll end down here. I remember Greg talking about it last year, down around 1720, 1730, and it completes it. I forgot what
there is a big triangle in gold taking place since the high that we found in the summer 18? Of 2020.
Okay.
So at some
year
point,
year and a half for consolidation.
Yes, exactly.
Before a move in the same direction.
As you said before, it's more a correction in time than in price, right? Because we've retraced a small percentage of the move higher while spending more time just in a choppy environment. And in my opinion, 2022 is going to be the year that this type of correction in gold and silver come to an end, and they begin another sharp leg higher. Now, I want to be fair, right? Inflation is extremely high, extremely higher than the numbers say. And I've explained it before, right? Owning gold and silver is not a get-rich fast method. You should mostly look at it as a way to, over long periods of time, to preserve your purchasing power than anything else, right? So people should be cognizant of that. And on occasion, there is a big lag. So on occasion, they don't follow the accrued inflation, but then there are violent periods of repricing, right? So yes, if you buy them just before the violent period of repricing, like for example, you remember the leg higher that gold made from 300 to 1500 or whatever. Yes, if you actually end up buying them just before the big leg of repricing, then yes, you can actually make money, make a lot more money than the inflation will have cost you in the period you held it. Now, if you're holding longer term, you at least know that you're not losing your purchasing power.
Right. And as we're talking, I believe the S&Ps are cutting through that trend line.
Yeah, but it's early on the day. I
remind
you that the S&P has done, if you look at the bigger wedge, not the shorter term trend line you have there.
Show your chart.
Sure. The S&Ps have done 3 attempts so far.
Yeah.
Let me show it. So the S&Ps have done 3 attempts so far to break through this trend line support. Right. 2 of them were last week. Yeah. And they held by the end of the day. So we had 2 rather bad days that ended up one in the positive and one barely in the negative. So, I'm not so much interested to see what's happening pre-market once again, but I'm interested to see if we can actually close below this trend line at the end of the day. That is going to be an important development. Now, intraday, we've seen many, many times that they come to the rescue. And what looks like a really negative day somehow magically by the end of the day has become a neutral day. So for me, that I'm not a very short-term trader, it's more about seeing the end of a daily candlestick than anything else.
Right. Okay. So we have a lot of coverage here. Stel, anything to add?
I just want to say we're talking about the dollar before, and I agree with Steve that the main direction in the medium term should be lower. But with equities kind of on the verge of breaking down, we still, like Steve said, we still haven't broken down, but they're on the verge. You know how the dollar usually reacts. It's usually the inversely correlated to equity. So you really do not want to be the short dollars here. If these break, then the dollar is going to have to rally. So just something to be wary of. I'm in sell the rally mode in dollars, and I think I'm not. Maybe it's a tough one. It's going to have to depend on the ferocity. If we do break, we're going to have to look at price action. But I'm definitely not selling dollars right here. I am looking to sell rallies though. Eventually, I'm still long euro pound, which is doing better today. The pound is actually weakening against most majors today. I'm not actually sure why, because we had average earnings and unemployment data, and they were good. They were kind of average earnings was in line and unemployment was better than expected. So that's not it. And I don't actually know why the pound is struggling today, apart from the fact that it had done very well over the past few months, and it's at some point it's going to have to correct.
The pound, by the way, still, since you mentioned this back testing, this broken channel. So
yes.
I'm really curious to see what happens here as well today, because it's not only the S&P that is testing an important trend line, it's also now the pound here. So I'm really, by the way, keep in mind the pound got rejected by the 200 daily moving average. That's where we actually found the high. So I now want to see, will this channel's broken trend line resistance act as support? If not, that's not going to be a good signal for the bulls.
Yeah, no. I was going to say there's still the issue of Boris Johnson and the trouble that he's getting in, but we didn't get any news today, so that's I don't see how that is the reason why pound is underperforming, but it is, and we have to wait and see how that develops. Now, equities we had a look at, and the S&P is on the verge, the Nasdaq is on the verge as well. And who was it yesterday? Was it Gareth Soloway or Nick?
Gareth.
It was Gareth.
Soloway. Yeah.
He was showing that really nice chart of the S&P where we are in a channel, and we had been pushing the top side of the channel for a long time. Now we're pushing the bottom side of the channel. And he said, this is not a good sign. And I have to agree. But we haven't broken yet. So, let's hold our horses and wait and see. And, yields are going higher, but we're still not broken. So.
In general, the price action here in the S&P is rather worrying if you're a bull, in my opinion, because we've had this that looks like an ascending wedge with a lot of RSI divergence, right? A lot. I mean, this high over there was with an RSI at close to 80, and this high over there was with an RSI at 64. So, it's obvious for the...
Is that an ending diagonal?
It's soon to tell, but it definitely looks, dangerous to be long here, right? Especially if you also take into account the big shift in rhetoric that we're seeing from central banks, which I think there is no single person out there that believes that central banks are not responsible for the huge 13-year almost non-stop rally we've seen. So, if you actually acknowledge that central banks and monetary policy have been the major tailwind for these gains, then it's impossible to ignore that a change in rhetoric and policy can act as a headwind, right?
Yes.
At the very least, investors will be a lot more jittery for now. So a lot more prone to want to exit, risky positions.
Let's see your VIX chart.
Yeah, absolutely.
Show us your VIX, or as they say in England, show us your...
Get your VIX out for the lads.
Yeah.
But I knew that would drag Ryan out here.
Yeah.
All right.
So here's the VIX. We have some divergences as well here, right?
VIX. Nice, fancy.
we had lower lows over there. We have higher lows here, but so far contained, right?
Right. Yeah.
Above 25, though, I think we opened the door for, a big move.
It's like an EKG with spikes in your heart rate, and then it calms down, getting ready for a heart attack.
Yeah, and you know how it is, right? Moves in the VIX can be brutally fast.
Yes.
Right, brutally fast.
Yeah.
So it's something people should be aware of. And I would honestly, I can't even fathom who would be selling VIX under current conditions, right? I know it's not that inexpensive in comparison. I remind you that we spent a period in the single digits, right?
Yeah.
Of course, that period is long gone now, and I don't think it's coming back anytime soon. But in my opinion, the VIX is still very cheap in comparison to all the underlying risks that we'll face during this year.
Okay. So a great rundown by Steve. Ryan, we have a little bit of time, some input as to, what you're seeing overnight. You feel a little better about how the yen has dug in its heels, or does reversal and BOJ bother you about being long?
No, now the BOJ's passed, there was very little risk that they changed tack, and they haven't. So it's back to business as usual. Today he's looking... People point at saying the pound's a bit weak, but it's looking a bit yen driven. Just looking at the usual weather vanes. Guppy's down, Euro yen's down, Aussie yen's down, and that seems to be dragging the majors. And Swiss is a little bit bid against the euro as well. So it's looking a bit risk offish, but a bit undecided. We have got New York Fed manufacturing out, which is the first manufacturing data of the month, or the new month. So that can be a bit of a bellwether for the data.
That's 50 seconds away, right, Ryan?
Correct. Yeah. Expect it's coming a little bit lower.
Let's before we get there, let's remind everybody that we are about the offer that we're running, right? We're still running it for a few more days. It's the best offer we do all year, and it's on premium, and it's buy 1 month, get 1 month free, or semi-annual, get 6 months for the price of 4, or annual, get 12 months for the price of 7.
Put the link in chat, please, Steph.
I'm gonna put the link on the chat, and we're 10
Okay.
seconds away.
All right, and then we have Alex Barrow with us.
Data in 5 seconds. Let's see what we get from the New York Fed. Oh, minus
Oh, wow.
0.7.
Minus.
Wow.
The previous one was positive 31.9, just for a reminder, right?
Nothing to see here. Move
And
along.
the expectations were for a decrease, but to 25. So we went from 31.9, not to 25 that was expected, but to negative. So that's a huge miss.
Big drop in employment as well to 16.1 from 21.4. Prices, obviously looking at inflation, down to 76.7 from 80.2. So a bit of a soft report there.
Very, very soft report.
Any market impact on this?
So for the time being,
S&P's bounced
nothing has
firm.
moved.
Yeah.
For the time being, nothing has moved. I mean, if
It's
you
a
were
funny
just
one.
looking, if you were just looking at the screens, you wouldn't imagine that there was any data that had come out, or that if there was any, it was exactly as expected.
Okay. All right. Well, thank you, team, very much. Great batting the ball around with you guys every morning. And there will be a morning edge, I believe, in 45 minutes for the team.
Course.
And, these are the kind of markets where it's not one way, and you'll get some great guidance. So to be on the morning edge, sign up and get involved with our community and make 2022 a better year than last year by surrounding yourself with great traders. Okay. And with that being said, I'm going to bring Alex Barrow in. And Alex, welcome back to F.A.C E. How are you, my trading warrior brother?
Hey, Dale. Good morning. How you doing, man? Can you hear me?
Good. I can hear you loud and clear. So, things have changed since you and I last talked, mainly with Fed rhetoric and yields beginning to squeeze to the upside. I'm curious what you have on your radar and what you're thinking here, Alex. You want to share your screen?
Sure, yeah. Let me see 1 second.
It's that little green box.
Okay. There we go. Can you see this?
Yeah. Okay. So trend fragility. Interesting.
Yes, this is one of our dashboards that we use, just a composite of a lot of the key indicators we like to look at. But like you said, it's been quite a 180 since the last time you and I talked, in just the general macro environment. You guys were talking a little bit about this as I was listening in, but I mean, it wasn't too long ago when we were priced at just easy Fed policy, QE, and now we've gone all the way up to 4 hikes this year, and a quick end to quantitative easing. So that has changed a lot, and the market has been really digesting this news. Looking at the indices, which are only a couple percent off of all-time highs, you wouldn't really notice it, but digging in, I mean, I was looking at a stat the other day. You have about a third of stocks in the NASDAQ are down over 50% over the last few months. So there's already been
it started in like April.
Yeah, no,
last
exactly.
spring.
So, right. Which is really kind of a healthy thing. I think, because it's you're having all these little tiny rolling bubbles, and then the air is being let out of those. And, and then but we're just seeing rotation of flows from one thing to another. But still, as my, if you can see this, my trend fragility indicator right here, which just looks at a composite of like a number of these things below here, sentiment indicators, positioning, fund flows, and stuff like that. It's been elevated for the last couple months, and it still is. It's in above
so
the 90.
That's like a yellow light to you, Alex? A caution?
Yeah, that's it just means to be cautious. The way I look at markets is I like to try to stack conditional edges, because I don't know what's going to happen. I don't believe in doing the vision macro thing and coming up with really complex, high conviction ideas and pounding the table all the time, even though, occasionally when a fat pitch rolls along, which is maybe once a year, we'll do that. But it's really just trying to see, okay, building context, trying to develop a picture, and then seeing if I have a divergent view from what the market or what the consensus is saying. The last 2 months, we've just been cautious. We've raised a lot of cash. We've been kind of running a net risk book, so we've been adding shorts with a lot of the meme stocks and the ARC names and stuff. But even those are nearing a little bit oversold, even though I think they have.
You're shorting Kathy.
Yeah. Kathy's been a big short. Yeah, I mean, because it's just. I mean that's an obvious play, right? I mean, when you see the Fed do a pivot, you got to go to the where the retail crowd has been piling in the money, and that's one interesting component, which is a stat that I've been like to point out over the last 2 months is, and this is a component of our trend fragility indicator. But if you look at aggregate U.S. equity flows, I mean, they've been off the charts the last 2 months, up to the 100th percentile. So if you see the last couple times this is hit, we saw it in January 2020, and then January 2018. And so typically this can be a bullish thing, like we saw it in early 2017. When you see this type of large aggressive inflows into U.S. equities, but that's only after a correction. So when you see this type of piling in after a very long extended trend,
they're bag holders.
Right. Yeah. I mean, it's a lot of bag holders chasing. So that typically precedes, months of, a sideways correction at the best and a deeper correction at the worst. So, looking around just generally at markets right now, I mean, I heard you guys talking about Euro USD. And that's something we've been probing the long side in the euro and the short side in the dollar this last 2 weeks. We played this breakout, but just with tight stops, so we already been stopped out.
People were declaring people were bearish a dollar on that sideways wedge. And then for a first breakdown day, that was the death of the dollar. So I think they just shook out dollar longs, and now they're going to squeeze dollar shorts, and then maybe we have a high. You know what I'm interested in? What are the inputs for nervous and dumb money? And how do you know what I'm doing? Have you seen my P&L?
Alex,
come on, man. You're hacking my.
Yeah, I don't want to give my secret sauce away into how I get your data. No, it's nervous and numb is it's a technical indicator that looks at the positioning of the VIX relative to its Bollinger Bands relative to the S&P relative to its Bollinger Bands. And so, we look at it on the weekly and daily time scale. Weekly gives better signals. This is a smaller chart, so it doesn't really show it. But I mean, when it comes down, you see that people have become, the markets become very numb. That's usually indicates a bottom. We're kind of in a neutral territory. They gave a sell signal back in early December, which, is pretty really spot on when. Yeah, well, I mean, we didn't get the sell off, but we've gone this, just extended range of chop, right? So
so let me ask you this: with all these things, all these warnings, cautions, now we're getting some price action that could actually break a trend line. All the prior corrections have been about 5%, really, and almost in lockstep. You bought a 5% pullback, and you were at new highs within 30 days or less. What type of magnitude decline are you expecting out of the setups that you're showing here today?
Yeah, so I wish I had a real sexy and exciting answer to that one, but our kind of MO the last 2 months has been really weak opinions, even more weakly held. Just because it's I don't think you can have a ton of conviction on direction in any of the major assets in this market right now over the next few months. So we're just kind of, like we're really focused on more idiosyncratic equity plays and stuff. that have interesting atypical drivers. But I mean, looking at the market, I could see it over the next 2 months going, dropping 10, 15, 20%. I could even see it, chop around sideways, go back to new all-time highs in a couple of weeks. It's
legitimate to say I don't know, and I'm just going to be tactical, and I don't have a narrative.
Yeah, I mean
we always feel like we need to have one, and then we feel like there's something missing because we don't have one, and what's missing is compelling evidence on one side or the other.
Right. Yeah. No. I mean, and that type of talk doesn't sell subscriptions or get you clicks or anything like that. But I think it's really important to know when you have an informational or analytical edge in the market and when you don't. And cash is a position, and it's okay to lighten up your trading or just move to we're focused on just more short term tactical swing trading strategies right now. Because I don't, like I said, looking at the broader market, I'm not smart enough to know where inflation is going to be 6 months out. I mean, you have Omicron wave spiking in China, which that's still putting the squeeze on the supply chain. But on the other hand, you have a lot of other supply chain pressures easing, and so in just a number of the goods and stuff. I mean, you have some freight cost coming back down. Whether that's gonna we've seen a peak like in the Baltic Dry Index or not is obviously to be determined. But I've read cases for arguments for both sides where we're going to see extended high inflation over the next year and a half, or where we're going to see it roll off. And I think you just have to kind of be very nimble and just play the data as it comes in and not be just stuck in your views because it's such a fluid environment.
Are you neutral on silver? I know that you had a bias last time we talked. Has the action changed your mind? And really, it's gone nowhere.
It's a whole lot of nothing. And like you guys said, it's been a correction in time and not so much space. We're long-term constructive on it. We don't have a position, so we're just waiting for technical signals to get long again. But if you look at some like I have this is some of the gold indicators we look at. Net call put open interest in gold is at very bearish levels, extremes, which you can see here.
So that's contrarian. That's contrarian.
Yeah, that's typically a good contrarian indicator. You saw that it hit these levels back in early 2019, right before the big run. Breadth in gold miners is really bad. Outflows have been reversing for the last 18 months. And so I think this is actually really constructive
sentiment wise.
Definitely. I mean, top positioning is still slightly long and stuff. But if you consider, how well precious metals have held up over the last year, considering the total flip in central bank policy, I think that's a good thing. And if you're like me, and you don't think that I think the Fed is going to step on its toes with these rate hikes probably later this year, and that inflation is going to die down probably a little bit. But I think real yields are going to end up staying deeply negative for a while. And so just the general macro environment continues to be constructive for precious metals, but it's not an actionable play right now. It's just something you have to watch.
Yeah. I'd like to see one more kind of flush in gold towards 1730, 1720.
Yeah,
and maybe one more low in silver. What's your silver chart looking like? The one thing I've from doing these interviews and talking to a lot of people, Alex, everyone wants to buy silver at 19. And I remember, many months ago you were talking 18, 19. So, and what that tells me is that it shouldn't get to 19. And if it does, it's not going to mean much. It'll go through his when everyone wants to buy one area. So what are you thinking here?
It's, kind of similar to gold. I don't have a strong opinion. I just expect more sideways volatile chop. I would love to see a flush down. But like you said, like if it breaks, below the current range and it falls through too much, then that would actually be, a pretty bearish signal to me, because this support that's held, this like 21 level that's held over last year should continue to hold. And if that can't, then that, tells me maybe I gotta have to, it's about time to start re-inspecting my views on precious metals. So yeah, it's just another one that I'm watching, and I don't really have strong opinion on.
Okay, so, from when we went on the air, it was down 10 cents. I'm seeing on your screen we're up 40.
Yeah, that's what it's looking like. Yeah.
It's a big move. Oh, okay, so maybe we are turning. Anything else you want to comment on in here, Alex? Anything you want to?
Yeah, one of the few markets that we continue to be bullish on, though it is getting stretched, is energy. The sectors leading. That's been the play for the last 12 to 18 months. It's probably getting a little overextended because you see a lot more people piling in, which is driving us to start raising a little bit of cash in that area. But we're still long-term bulls, just because of the dearth in capex over the last decade. That's going to continue to put pressure on supply, and as demand continues to recover, once this Omicron wave continues to roll off, we should see energy sector continue to do pretty well. And considering how well it's done with the dollar in a general bullish trend, that says a lot, because like I said, I'm still short term I'm pretty agnostic on the dollar, but longer term I'm becoming just increasingly bearish, just because of the high capital concentration we have in the US. So that can't continue indefinitely, but it can continue. Who knows? Maybe that plays out another couple of weeks or a couple of months. But eventually, we're going to start to see some of that capital reverse and go back out from the core to the periphery. And that, so
you're looking at opportunities in overseas markets, emerging markets, European markets.
In select names in certain countries. We're not bullish on emerging markets broadly yet, but there's some constructive developments recently. China's starting to ease, which is good, even though it's not going to be a major easing cycle like we've seen in years past. Growth in India has been improving, and so we have a longer term secular kind of bullish theme on India, where they're hitting this major demand S curve, just because of their GDP per capita is hitting a certain level where you start to see kind of exponential growth in demand for certain goods like energy, commodities, and stuff like that. And so that should it's not going to directly replace what we've had from the growth tailwind that China's provided for the world over the last 15, 20 years, but it's going to help at the margins. And so if with that combined with China trying to stabilize things and stuff like that, we could see some improved price action in emerging markets. But also that's probably going to take a real cyclical bear market in the dollar to get going.
Okay. Well, I appreciate you being here with us today, Alex. Best way for people to follow your work and read your stuff and keep in touch with you.
Yeah. Well, yeah. Thanks for having me. It's always a pleasure to talk. If anybody wants to follow our work, visit our website at macro-ops.com, or find me on Twitter under the same handle.
All right, Alex. I hope 2022 is one of your best years ever. I root for you and appreciate you showing us some things that we may not have been aware of, and things that your view on the dollar I think is interesting. And wow, you were what a turn of events in silver while you and I were talking. It's amazing how things can change in 30 minutes when you turn.
I know, right? Yeah.
You know, it reminds me of that expression, to be there for the good times, you have to be there all the time. So anyway, I enjoyed our talks, and we'll set up a time to do it again. So good hunting, my trading warrior brother.
Right back at you, Dale. Always appreciate it. Have a good one.
All right, Alex Barrow, everyone. Follow him at Macro Ops on Twitter. Go to his website, and I think Alex has some great macro ideas, big picture stuff, and I think it's worth your time to take a look at what he does, or I wouldn't bring him on. So thank you very much, Alex. See you down the road, and everyone, good luck on your turnaround Tuesday, and you could join the team in 25 minutes on the morning edge. Thank you for your attention. And don't just count your pips, count your blessings. Adios. Thanks, Alex.
Thanks, Dale. Take care, man.
Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.